This is the first time in years, probably 5 years, that I can find a condo priced around 400K. We're going to quickly transition from a period now where we're seeing probably a bit of an oversupply of units to one where we're severely undersupplied. That's going to happen fairly soon.
Today's guest is one of the most respected voices in Canadian housing market analysis. We're excited to welcome Shaun Hildebrand, president of Urbanation. Shaun brings years of experience interpreting the stories behind the data, and today he's here to help us make sense of where the market is headed in the second half of 2025 and beyond. We'll dive into key insights, discuss investor strategies, and explore opportunities hiding in plain sight. Shaun, welcome to the show.
Great, thanks for having me.
Yeah, thanks for being here, Shaun.
Appreciate it.
No, we're looking forward to this conversation. It's a fascinating time right now.
It is. So, Shaun, in your, expertise of what it is you do every day, tell us where the market is in terms of inventory, sales volume, and prices.
Sure. So as we entered 2025, the market actually had some momentum.
Mm-hmm.
We were on our way to seeing some meaningful recovery in sales. Prices were starting to firm up. Inventory levels were basically normal. Activity was actually up in Q4 2024 by about 20%. So I think the interest rate cuts started to work at that point. And then Trump happened, right? Sales activity slowed considerably in the first half of the year. Now we are starting to see some improvement. And this is really just a sentiment thing, right? I think there's just so much uncertainty, economic uncertainty with what's going to happen with respect to the economy as a result of the ever evolving trade situation with the US that, a lot of people are concerned about their job security, really. Interest rates have kind of been sticky. We saw the Bank of Canada pause interest rate reductions as they were sort of trying to figure out what's going on with the economy as well. So interest rates are sort of, still kind of, I wouldn't say restrictive, but they're higher than where they were pre-COVID for sure. Prices have come off a little bit, but affordability is still a challenge. So when you combine affordability challenges with economic uncertainty, it's created some, reductions in sales activity. I will say though, since the bottom of the market, which was probably around February or March, we have seen gradual improvements. So if you look at month to month activity and you seasonally adjust it, sales have actually been improving for the last 3 months, which is good. Sales volumes are still exceptionally low, but we are seeing steady increases when you look at, we're starting to slowly see buyers re-enter the market. Inventory levels are high, right? We know this. They're up, actually, they're probably double where they were just 2 years ago. There's over 30,000 active listings in the GTA right now. About a third of those are condos. So it has to do a lot with the fact that we're in a record year for condo completions. So that's adding a lot of inventory into the marketplace. We've also seen a lot of mortgages reset this year, right? Going back to 5 years ago, coming out of COVID, when a lot of people were buying homes at record low interest rates, those homes are now coming up for renewal in terms of their mortgages. Now, the value of the homes are still higher than where they were back then, probably by about 20%. So homeowners are still sitting on some good equity there, but they are experiencing higher interest rates. So, there's some changes that are happening, some moving within the market as a result of that. But there hasn't been really evidence of a lot of distress selling. Right? We're still seeing that mortgage arrears are at low levels. They're up from where they were, a couple of years ago, but they're still at very modest levels. Nothing concerning. Prices are actually holding up fairly well given the circumstances. Like if you were to tell me that sales were at a 25-year low, the ratio of sales to new listings was at 30%, which is a deeply buyer's market. Inventory was at a record high. We had more than 5 months of supply, 7 months of supply when you look at the condo segment. I would tell you that prices would be correcting a lot more than they have.
Yeah.
But if you look at average prices today compared to a year ago, they're down by about 5%. If you compare it to 2 years ago, they're down by about 7%. That's not that much of a correction, really,
No.
Given how much growth there was over the last number of years. So I'd say the thing that I've learned the most out of the last 2 or 3 years is just how resilient the Toronto housing market has been.
Mhm. And would you say now, taking all this into account, are we already into a new cycle, or are we still bottoming out? What's your sense?
I'd say we're probably at the bottom. Okay,
Yes.
so we've
Yeah.
probably seen the worst of it, and we're seeing some gradual movements up from there. So we're in the early stages of the recovery, I would say.
And it's hard for people to sense that, because it's not like the recovery means you're going to have a massive amount of
No.
sudden, transaction volume and prices are going to pop. That's not what a recovery really looks like.
No.
It's just what are the key sort of indicators when you say you're seeing that early signs that would point you to say, okay, we're starting to move in the positive room?
Yeah, there's definitely still some headwinds for the market, right? The economy is a big question mark right now.
Yes.
And when people are uncertain about their job or the economy, they reduced big ticket spending. And the biggest ticket spending item you can make is really housing. So
Yes.
that's sort of slowed down. But we've seen consumer confidence indicators improve month to month over the last 3 to 4 months, which is good, right? For better or worse, I think consumers are getting used to the trade conflict.
Yeah.
I think they're sort of understanding that this is going to be with us for a while. And there probably will be tariffs in some degree, but probably not the big numbers that are being presented in the media, right? I think there's some negotiation tactics out there that are perhaps causing a little bit more fear than there should be. But I think the fact that we're seeing sales lift off of those lows, I think is the first sign. Some segments of the market are actually seeing growth. So when I look at single family homes in the city of Toronto, sales are up year over year. It is the only segment of the housing market right now that is seeing growth. There's other areas of the market as well that are actually continuing to do reasonably well. The luxury market is holding up relatively well. The luxury market, generally speaking, if you look back historically, has been a leading indicator for the housing market. So when the market turns, it's the luxury market that usually pulls back first. When the market improves, it's usually the luxury market that leads the way. These are discretionary buyers, right? They're not necessarily as tied to interest rates or general economic conditions. They have wealth, and it's more of their sort of sentiment about where things are going. Because they're smart investors in a lot of cases, and they're looking at opportunities in the marketplace, which is what I think we're seeing right now. The other thing that I'm seeing that is quite remarkable is the growth in entry-level condos. Right? There's a lot of negativity about what's happening in the condo space and the fact that condo sales are falling, which is true. But if you look at sales of units priced under $500,000, they're up 47% year over year, year to date, right? So I think there's sort of an opportunity here for a lot of renters who have been paying increasingly higher rents to say, this might be an opportunity for me to get into the homeownership market. Given that condo prices have come down, this is the first time in years, probably 5 years, that I can find a condo priced around $400K in a good location.
Yeah.
Yes.
When I do the math on the mortgage, it's probably more economical to own than rent, with an outlook of holding the unit for at least 5 years, right? If you're out there to buy and flip a unit, you're taking on some risk still.
That's a speculator's play, not a homeowner or long-term investor.
So generally, if I look at the core of the city, which is, again, usually a good leading indicator, it seems to show stabilization and some modest improvements in terms of sales activity.
We laughed a little bit when we read your report last month, because you said in there, it says the under $500,000 price points increased by 47%, and we're like, yeah, but there were no condos for under $500,000 a couple of years ago, which is also a big factor to that. Segueing, I guess, into the condo story here in the GTA, Shaun, obviously a big part of our market overall in a city like Toronto. And you mentioned, of course, the record year of deliveries of the 30,000 units coming on the market. Tell us a little bit more about the rental market and what's happening with the investor story here in the GTA.
Yeah, so between 2024 and 2025, we'll have 60,000 condo deliveries. That's normally a volume of condo supply that we'd see over the course of 4 or 5 years. So we're getting it in 2 years. A lot of those enter into the rental market. and probably more so now than ever because of the fact that it's difficult to sell your condo unit. A lot of investors are just staying put. So they'll test the waters and put their unit up for sale. They probably won't get any showings or very few showings. They won't like the fact that they have to reduce their prices. So they're saying, well, you know what, I can hang on in the rental market. And that's really one of the stabilizing factors for the market, is that we have an undersupply of rental properties. So there's an outlet for these units. You can hold on to them in the rental market and still lease them out pretty quickly. Now, granted, the market has softened some, right? Rents are coming off a bit, but I think that's just more a function of the volume of supply out there, and also the unsustainable rent growth that we saw in 2023 and 2024. We were seeing double-digit rates of rent increases. Rents normally don't rise by more than incomes, right? Incomes can't catch up to rents when they're growing that quickly. So affordability deteriorated very quickly, and it was in a very low supply environment. Now we have more supply, there's more negotiation power for renters. So rents are coming back down towards their equilibrium level, right? I don't think it's a sign that there's any sort of underlying issues with the rental market. I think it's just a correction from an overshooting of rents that happened in 2022 to 2024. Now, we're also seeing that the population is starting to slow down, right?
I was going to ask you about that. We've had tremendous population growth, and there's now been a change in, we'll call it the strategy of the
government,
the federal government. So that's. I'm glad you're going to touch on that.
Yeah, and that's the two key drivers of the rental market. You have population growth and you have supply. So on the one hand, we have more supply than we've ever seen. It's temporary, but it's happening. And then on the other side, we've seen a switch in policy from the federal government. So the biggest shift is not so much their reduction in immigration targets. These would be permanent residents. So they've been reduced, but they're still exceptionally high, close to 400,000 a year, even higher than where they were prior to COVID. Okay, so they're not 500,000 like originally planned, but they're 400,000, which is still extremely high. That's not really the big change. The big change is the reduction in non-permanent residents. So these would be international students, temporary workers. That was where most of the population growth was derived from over the last couple of years. In the GTA, we had population growth of like over 500,000 people within a 2-year period. Like that's like adding another Hamilton into Toronto, really, in a 2-year period. So that is obviously not good for the sustainability of the housing market and the broader economy and other factors like healthcare and education, things like that, right?
Yeah.
So we've seen the government correct that policy, and they've introduced some targets for non-permanent residents. So what that means is that they're actually looking to lower the number of non-permanent residents in Canada over the next couple of years, which in effect will lead to either a slight decline in the population or probably a flattening out in the population. So it's not as if we're going to be giving back all of that population growth that's happened, but we won't see the same level of growth as we've been seeing in the last number of years. So the flattening out in the population and the record amount of condo rentals that are hitting the market at the moment has led to some deflation in rents. Rents are down by about 5 or 6% year over year, but they're still higher than where they were a few years ago. The vacancy rate is still below 3%. Like it's not as if landlords are struggling to find tenants. It's just they have to adjust their rents and probably offer a little bit more in terms of incentives to get tenants,
So based on your research, at Urbanation, is it fair to say that you don't feel like that small reduction in immigration is going to have a major impact on the rental market?
Well, it's having a temporary impact on the rental market. And this is again, we don't know exactly how this policy is going to shake out. They could switch courses, right? Sure. Which is known to happen.
I mean, not like the US, but yes, it is known to happen.
It's known to happen. And we also have to consider, look, rental demand is at a record high, not only because of population growth, but also because of homeownership affordability, right? Homeownership affordability, if you measure it on the basis of looking at mortgage costs as a percentage of income, we're at one of the highest levels that we've seen since the early 1980s, right? It's still challenging. So homeownership is getting delayed, right? And we've seen some stats come out on the average age of a first-time buyer. It's going up and up and up every year. So that puts more demand into the rental market. Because of that, households that normally would have bought are renting, and they're doing so with higher income levels, right? So they're boosting rents as well. They're able to afford the higher rent properties that are coming on the marketplace. And I don't know if we'll touch on it all, but there's certainly been more purpose-built rental happening in Toronto. These tend to be top of market rentals, right? Interestingly, the demand has been there, right? We've seen these units lease out for the most part in fairly short order. And, we're learning that there's been an underserved market here of rentals geared towards professionals with higher incomes that either can't afford to buy or they simply don't want to right now.
They want the flexibility, especially with trading costs being as high as they are now. I mean, if you've got, a changing life situation, but you don't want to rent a, 1-bedroom box in the sky down here in downtown Toronto, you want something a little bit more purpose built, a little more high end. You can see why that would be a market that has been underserved, because when we'll talk about it in a minute, the developers were so focused on just, building resale projects. You told us more than anyone else that idea of purpose-built rental basically stopped for a while. So I guess that does make sense that there is, in a city of our size, a lot of people that do want a higher end purpose-built rental, opportunity for themselves.
Yeah, and it's not as if it's crowding out the condo investor. I think it's really, I don't view it as a substitute. I view it as more of a complement. So you have condo investor rental units that are serving kind of the mass market for the most part. And then you have these higher end rentals that are coming in and offering, a different level of service, different level of finishes and amenities. In a lot of cases, you'll find that if you look at a brand new purpose-built rental building, a lot of the tenants are graduating up from neighboring condo buildings. And a lot of property managers will tell you that. But it's still a fairly small number, right? When you look, there's been this narrative around the fact that we're building all of these purpose-built rentals. It's still fairly minor, okay, in overall total volume. And when you kind of look towards the next few years, and you see that condo completions are going to be dropping, there won't be as many investor-held units hitting the market anymore. We're going to quickly transition from a period now where we're seeing probably a bit of an oversupply of units to one where we're severely undersupplied. That's going to happen fairly soon.
Yeah, I mean, that's, I think, the biggest question that I'd want to know next, Chris, is, Shaun, predict the future for us. We're in an environment right now where you just mentioned 60,000 units being delivered in 2 years. That's more like 4 or 5 years. Clearly, the pre-construction sales side of the business over the last 3 years has been very slow. So, what does the condo market look like in our city in 3 to 5 years?
Yeah, so in the first half of this year, we sold maybe about 1,000 pre-construction units. That's about 10% of normal volume. In a normal first 6 months of a year, you'd sell at least 10,000 units. So we're 1,000 units.
Amazing.
We're now into the 4th year of this downturn. It's significant. Like, this is the biggest downturn of our generation for sure, or my generation.
Are we the 4th largest city in North America? We're the largest in Canada, but I think we're the 4th largest in North America.
Yeah.
And we've sold 1,000 units. That's it.
And now you're seeing construction starts follow the same trend. Construction starts were like 80% below their 10-year average in the first half. So it's hitting the construction sector hard. One sort of little known fact is that we have the fewest number of condos under construction in the city of Toronto than we've had in over 10 years right now. So the supply squeeze is already starting to happen within certain segments of the marketplace. Most of the new condos that we've sold over the last 5 years have actually been located in the 905 region. Yeah. So that's where the supply is kind of hitting.
And why is that?
now.
Right now. Yeah.
And why is that?
Well, I think there was affordability shift, right? As prices in the core reached, $1,500 a square foot plus, investors and builders started to look towards areas that were still attractive, close to transit, mixed use, densely populated pockets of the 905. They started to intensify those even further. And condo sales in Vaughan Metropolitan Center, Mississauga City Center, out in Oakville even, Scarborough, Pickering, like all of these areas just exploded with new development and actually represented the majority of new condo sales. So when we're looking at supply in the next couple of years, yes, it's going to remain high in the near term, but it's also fairly well dispersed geographically. It's not as if we're building 30,000 units and they're all in the downtown core. It's actually the case that we're building fewer units right now in the downtown core than we are in the suburbs. So supply, interestingly enough, is already starting to tighten up a little bit here relative to the 905. Like if you look at months of supply and other metrics, it's lower in the core than it is in some of the suburban markets because of the shift in supply that's happening right now.
Interesting.
So where's the opportunity for investors then? Because keeping on this theme of condos, what are you seeing now? Is it now the time to look for opportunity, or where would you find that? You mentioned the submarkets outside of Toronto, Hamilton, Milton, Oakville,
Kitchener-Waterloo.
Yeah.
Like there's so many options. What's your overall, or is Toronto really the place to be looking?
Yeah, I think if you look at the big picture, we're probably in the very late stages of the condo correction. There's probably a little bit more price deflation that will happen. But if you can find the right unit in the right building in the right location, I would say it's a good time, especially if you have a time horizon of holding for at least 5 years, right?
Yes.
Understanding that in 5 years from now, we're going to be in a very supply constrained marketplace, very supply constrained.
And that's predetermined. Like there's nothing that can happen now.
No.
To change that.
No. And that's sort of the nature of the condo market, is that it operates it's highly cyclical. It operates in 5-year cycles almost consistently. And that's because of how long it takes to go from pre-sales to completion. It's usually about a 5-year period. So when you buy a pre-sale, you have no way of knowing what that market's going to be like in 5 years.
Yeah.
The only thing you can know is that if you're buying in a market with a lot of other pre-sale buyers, you're going to be closing in a market with a lot of supply. Now, if you enter into a period where demand is slowing at the same time, like we are right now, it's just sort of unfortunate, right? Yes. But if you're buying at a time when no one else is buying, you're also going to be closing at a time when no one else is closing.
Which is exactly what you just described with today's 2025's first 6 months, 10% of normal transaction volume.
Yeah.
So 2030, we'll call it 5 years out, there's going to be arguably, there'll be very few, hardly any, like a rounding error worth of deliveries, right?
1,000. Well, like if we get through the back half of this year, and let's say we do the same, let's say there's another 2,000 total pre-construction sales in 2025. Does that mean in 2030 there's going to be 2,000 condo completions?
Basically.
That's wild.
And so you think about that, like you said earlier in our conversation, we've delivered 30,000 units, or
we will this year.
This year. So we're going from 30,000 deliveries to arguably 2,000 deliveries.
That's correct.
Yeah.
Think about that impact on the rental market.
And you can't change that.
And it's not something that's going to be like a one-off, right?
Yeah.
Like, this slowdown has been happening for years, and it's probably going to continue for the rest of this year and at least into the early part of next year. So there's going to be a window of almost no supply entering the market from the condo space. And this is going to happen actually fairly soon. So when you look at the trajectory for condo completions, by the second half of 2026, they start dropping like a rock. And it just kind of keeps getting worse as you go into 2027, into 2028. Now, I will say, we still will have some supply issues with us for at least until 2027, even with a lower volume of completions, because that's when the units that were pre-sold at the market peak will be delivered. Okay, so those are the units that were pre-sold for $1,400 a square foot,
Gotcha.
$1,500 a square foot, will be coming to completion in 2027. There's going to be a substantial price gap between what those units were sold for and what current market value is. If you look at the average price of a newly completed resale today, it's about $950 a foot. So there's still going to be some challenges with closing, but I think investors at that point will find ways, right? It's much easier to try to figure out a way to close on your unit when the market's doing better. When the market's doing poorly, as it is right now, there's less incentive to try to find ways of closing, which is why you're starting to see some buyers walk away. It hasn't been widespread. It's been fairly well contained, and we've been doing some research on this. We've seen an increase in builder-held inventory at completion. These are good opportunities to buy, right? You can get condos today at a price level that we haven't seen since probably 2020, even 2019. In some cases, even 2018.
Wow. Yeah.
Like I'm talking less than $1,000 a square foot, less than $900 a square foot. In some cases.
We're seeing that a lot in certain pockets.
And you start to run the math on that. Like, how much rent would I need to cover my mortgage at that price? Where's that price going to be in 5 years? It's the numbers start to work. And I think that's what we need to get back to in this market. Let's get back to the numbers, right? Because I think when the market was on fire, we lost a sense of the actual math of condo investing.
Yeah.
And there was a little bit too much speculation in the market. Let's get back to long-term rental investors that are in it for long-term capital appreciation and generating cash flow. We'll get there. And it's a correction that was necessary, but we're going to get there.
Like you just said earlier, the math is working. Like if you pencil it out, it's working.
It's just confidence, right? It's getting like, it's hard to buy when no one else is buying, right?
Yes.
It's the hardest thing to do. And there's some sales that are happening. I'm not going to tell you that the market's completely dead. If you look around, there's still some projects that are moving units.
Yeah.
These are astute buyers, right? They're looking at this from a long-term lens. There's nobody buying right now thinking they're going to flip the unit next year. That investor is gone, probably for the foreseeable future. And with that, we probably won't get back to a point where we're seeing 20 to 30,000 condo sales in a year.
You know, Shaun, I know a lot of builders, industry experts come to your firm for your predictions. What is your prediction for the rest of 2025 and 2026 for the market overall?
Yeah, so I'm an optimist, but
Are
I'm also a realist. So I think we'll see probably much of the same, a gradual improvement. I think if you overall look at sales, I'm not talking about the condo space, but the overall volume of MLS sales in 2025, it's probably going to be fairly similar to 2024, right? Maybe down slightly, maybe up slightly, maybe even, but it'll probably be similar, which is not great, right? 65, 66,000 sales. For a population the size of Toronto that has increased, by 2 million people since the last time we saw sales this low in the early 2000s, it's way, way too low. Like if you were to look at sales on a per capita adjusted basis, we're pretty much at record lows right now. So it's only a matter of time, right? There's so much pent up demand out there for housing. So it's going to get unleashed at some point. We just need to see the right conditions.
Yeah.
And I think we're heading there. I think honestly, with another 5% reduction in prices and interest rates coming down, another 50 to 75 basis points, that'll restart the engine. I think we'll start to see things move.
Do you think even if let's say that happens, but we still have, tariff noise or the deal has not been negotiated with the US, do you think that really is the driving factor or is it affordability? That's the biggest question we're getting right now.
Yeah, it's
is
both.
It rates
I mean,
or is it confidence?
Different markets will react differently to the economic situation with the US, depending on their reliance on US trade. So, there's certain parts of the country that are heavily reliant on their GDP for US trade. Toronto, not so much, right? We're very much a service sector based economy. Indirectly, we're definitely exposed to trade with the US through market confidence, financial markets. Obviously, the downturn in the real estate market, right? Real estate's huge in Toronto in terms of its percentage of the economy. But we're not, Kitchener-Waterloo, Cambridge. We're not Windsor. We're not as heavily tied to U.S. trade. So I think, unfortunately, we just kind of have to get used to this situation, right? There's going to be some impact to employment, right? The unemployment rate today, outside of COVID, is at its highest level in 9 years. We have a relatively higher level of unemployment in Toronto compared to the rest of the country. Partly because we have had so much population and so many people looking for work that it drives that number higher, but also the downturn in the real estate sector. Unfortunately, there's been a lot of layoffs, right? Anyways, I think that will continue to be an overarching theme for the market, at least through the rest of this year and into the early part of next year. It's that economic uncertainty that's going to hold back sales from what they normally otherwise would have risen to. But I think you'll see consumer confidence gradually continue to improve as, again, hopefully the economy stabilizes. And I think we've seen some signs of that.
Yes.
There was originally some data that came out that showed that, the economy was declining and inflation was growing very quickly. But that narrative has started to change in the more recent data, showing that things have actually held up relatively well. Inflation has been contained, still below 2%. Businesses are finding it's difficult to pass off price increases right now, right? Like they're experiencing higher costs and expecting higher costs, but they can't really pass those prices off to consumers in a softer economy. So inflation has remained fairly subdued. And the expectation is that amongst businesses, they'll be able to raise prices by about the same rate as they raised them last year, which means we're probably going to continue to see inflation trend at 2% or just below, which is really the preconditions for allowing the Bank of Canada to continue
Yeah.
lowering interest rates, right?
That's all
This
we've
is-
heard for like 18 months now.
It's
2
just-
years now.
It's just the tariff situation has stopped, all sort of decision making as it relates to interest rates to just try to figure out what to do, right? When you have no idea what's going on in the economy, you don't do anything, right?
Mhm.
You
You
just
sit.
sort of sit and wait. But now I think, with a little bit more clarity, hopefully, every month we seem like we have this trade deadline that we're
Mhm.
working against, and then there's another one that we have to work against. So I think it's just sort of something we continue to work against. If you look to, the next several meetings, the expectation is that by, this time next year, we'll see rates down by 50 basis points or 75 basis points. So we're almost at the end of the easing cycle, but there's still a little bit more there, which should hopefully bring rates down to, just under 4%.
Yep.
Mhm.
And I think that'll be the catalyst, I think, that'll help to bring more buyers.
Even where rates are today, I don't think they're
No.
terrible. I
No.
mean, if you look at the history of interest rates, it's in a pretty good place.
They're in a good place, but they're not at a level that's going to really spark more demand to come in, right? If you look at today's prices in rates, it's still challenging, right? So generally, I think the second half of this year will be better than the first half, and 2026 will be better than 2025. Prices, I think, will probably continue to slide a little bit lower just because of how much inventory is out there right now, right? With so much inventory, you're going to get more sellers competing against each other, and naturally you'll see some price reductions. I think that's realistic. But waiting for the bottom of the market, I think, is a tough thing to try to
Time.
Tough to call.
right? Like, we're not far off. So if you can find the right house again, or the right condo in the right location, and again, you have a realistic expectation for how long you're going to hold the home for, this is probably the best time to buy in a long time, right?
Mhm.
We're in a buyer's market. You have the
Mhm.
negotiation power. You have more than enough inventory to choose from. And like I said, there's signs that certain segments of the market are already starting to tighten up again.
Mm-hmm.
And so it's tough out there. I mean, there's so many headlines, so many competing theories and thoughts. For somebody who's interested in kind of trying to cut through that noise, how do you guys do that? Like, what do you think we need to be looking at to kind of cut out the drama?
Yeah.
And say, okay, what are the facts? Like, what facts do we need to be really focusing in on to give ourselves confidence? Warren Buffett always says you want to be buying when other people are selling and selling when other people are buying. Well, now's the time, to be buying, right?
Yeah.
And what do you think if we were sitting with Warren Buffett, what would he be thinking about the market today? Where do you think they'd be looking?
I think it's tough to forecast demand. Okay, so demand is reliant on so many different factors, as we know, and it can be volatile. It can depend on market sentiment and psychological factors as much as it can affect or be affected by the economy and population growth and things like that.
Mhm.
Very difficult to determine. Sometimes I think you should not asking just economists about the outlook for housing demand. You should be talking to psychologists as well, because it
Yes.
really is an emotional thing.
Yeah.
So I think those things will fluctuate, but generally over time tend to see pretty steady growth, right? Demand tends to rise over the longer term. Population increasing and just demand for housing rising alongside with it. Probably the best predictor of where the market is going to be going in terms of price, which then leads to an increase in demand, is construction activity, right? So that's what I look at closest right now. It's what's going on with actual construction.
Mhm.
And if you look at construction in the city of Toronto right now and the GTA, it is at its lowest levels in nearly 30 years, right? We know this. So you don't have to predict half of the equation of the housing market. We know for sure what's going to happen. So if you forecast where deliveries are going to be in the next few years, and you look at the relationship over time between housing completions and housing prices and what that tends to do to demand and consumer confidence and improving sentiment in the market, we know that we're going to be in a stronger market, I think.
In terms of sort of lessons we should take away from what we've learned in the last couple of years.
Have we learned anything?
Yeah.
What have we learned?
What have we learned?
What have we learned, Shaun?
We've learned a lot. Like I said, I've learned how remarkably resilient the GTA housing market is, right? In the face of sales plunging to multi-decade lows, inventory levels soaring to levels we've never seen before, consumer confidence plunging. Like, there's so much uncertainty out there in the world, right? And the market has still remained relatively resilient, right? We haven't seen a ton of foreclosures. I think, some of the policies that the government introduced when the market was at its peak, in hindsight, were good measures.
Very good.
The mortgage stress test that everyone sort of derided at the time, in the end, probably helped save this market from further distress. We have very prudent lending standards in Canada. This is not the US in terms of its correction. This is much different. And structurally, the market still remains very sound, right? We are a country that relies entirely on immigration to fuel our population growth. Immigration policy, regardless of who's in charge, is going to remain very accommodative, right? Very, very pro-immigration in terms of our policy here in Canada. So we know that the population is going to continue to increase. There's demand around the world to come to Canada, right? And over the longer term, the housing market will continue to perform well. One thing I've noticed in the data over the course of the last few years is that when you look at the 10-year rolling average increase for housing prices, they've now moved back down towards their 50-year average, right? So if you were to look at this measure 3 years ago, you would see that on average housing prices in in the GTA were increasing by 8% every year. You thought, well, is that normal? No, that's not normal. If you look at the context of the last 50 or even 100 years, prices don't increase 8% every year consistently. Now we're back down to around 5.5%, right? That's our 10-year average. So in a way, we've seen a reversion to the mean, right? We've seen the correction play out. It needed time, right? We overshot so much. This was not a correction that was going to happen over the course of 12 months, right? No. It's taken 4 years. It's probably going to take 5 years in the end. But it is restoring the fundamentals and the fundamental value of housing in the real estate market in the GTA.
Yeah. So there's lots of opportunity ahead. We just have to grind through a few more months or...
Look, I'm not expecting that we're going to see housing prices, shoot to the moon in the next few years, right? And I don't think that's good for the market either. It creates it's way too much volatility, right? But we should see gains, I would say. If you look at the next 5 years, even the next 2 years, housing prices will be higher than where they are today. I'm pretty confident in that. Condo prices will be higher, I think, than they are today. Will they be 40% higher as completions fall? Probably not, right? Let's be realistic here. Prices are still fairly high. $1,100 a square foot is still pretty high for a condo, right? The demand, I think, will start to pick up. The condo market, I believe, is going to fundamentally evolve out of this correction as something much leaner, but structurally more stable. And I say that by thinking that we're going to be less reliant on speculative investors.
Mm-hmm.
There's going to be a greater balance between end user purchasers and long-term investors. We're going to go back to the way things were 20 years ago, right? Where the market was selling to a mix of end user buyers and investors. The investors that were buying weren't necessarily in it for quick returns. They were longer term investors. We're going to see more design oriented buildings, less reliance on studios and 400 square foot one bedrooms. We're going to see a more balanced mix of housing, and it's going to be at a more manageable scale, right? I think this is something that is evolving naturally through market forces, but it's something that the city should also recognize as well, right? If you want more 2-bedroom units and 3-bedroom units, well, create some incentives to build them, right? Because right now, you're paying higher development charges for 2 bedrooms and 3-bedroom units than you are for studios and ones.
That's right.
And you're prescribing development to happen in certain areas of the city where you're allowing a lot of density, but the floor plates are small. So the units have to be small, right?
Mhm.
Allowing more density in all areas of the city will help to move along this evolution of the condo market. And we're starting to see that slowly, right? It's not going to happen overnight. You're allowing fiveplexes, and there's talk of lowering DCs or waiving DCs on certain numbers of units. It's all a step in the right direction, and it's a sort of a gentle easing into allowing more density into areas of the city that previously were just zoned for single family housing, right?
Mhm. Yeah, that's great. I think you heard it here first. Shaun Hildebrand is saying, "Don't count out Toronto's market yet."
No,
Yeah.
it's down, but it's certainly not out.
Not out.
Fantastic. Shaun, thanks so much for giving us your very thorough insight. You and your team have always done an incredible job at keeping us really well informed. We rely on your advice and your data and your commentary every month, and it's made us smarter for sure having it. So we're grateful for that, and thanks for being here.
Yeah, of course.
today.
Thanks for having me.
Appreciate it.
Yeah.
Anytime.
Thank you.
Thank you.